Good day, everyone. This is Datapoint Forex and Tech Academy. Today, we'll be looking at basic of market structure. Basic of market structure. So, before we look into that, let's explain what market structure is. When we say market structure, it simply means how the market reacts, how it moves. In short, you can call it the behavior of the market. So, the market moves from point A to point B, from a buy area to a sell area, sell to buy. That's market structure taking place. Now, under this market structure, we have various types of structure that we trader look into before we actually go in for a buy or for a sell. One of the types rather of structure that we look into, we have three types. We have the uptrend, downtrend, and the ranging market. The uptrend, the downtrend, and the ranging market. So before you go into trading, you need to understand, or before you take any trade, you need to understand what the structure is telling you. What the market is telling you, you need to understand it first. Then from there, you can know how you would enter your trade and where you should target for your profit level or your stop loss level. Now, let's get into the examples. The first we'll be looking at is the uptrend. Now, when we say market is trending up, or market is on an uptrend, it simply means that the direction the market is heading, where it is currently, is pushing up. Where it's heading is up. Now, what do we mean by this? Let me make an illustration. When the market is heading is on an uptrend, we have something like this. It pushes down, then it pushes down back, pushes up again, down and up. This is an example of an uptrend market. When the market is on an uptrend, this is what you will notice when the market is on an uptrend. Now, this pattern here, most traders call it the higher highs and the higher lows. That's how they determine, or that's how they identify the uptrend. So why is it called higher high or higher low? The reason is because every point the market creates, when I say point, I mean the highs and the lows. Every point the market creates is higher than the previous point. For example, now let's look at the lows. When the market created this low over here, then it went up to this point to create a new low. Let me mark it out. Now you will notice that this new low that the market created here is higher than the previous low. So this is what we call a higher low. Now the market pushed up again and created a new low. Now this new low that the market created here is higher than the previous low. This is higher than the previous low. So we call these higher lows. Now you notice the high. Anytime the market creates a high, the highs are higher than anytime it creates a new high, it's higher than the previous high. Now we have a high here. So the market pushed up, created a new high over here. Now this is called the higher high. This high is higher than this previous high. Now it pushed up again, created a new high. This is another higher high. Now the market will continue like this because it's on an uptrend. Every high it creates will be higher than the previous high. The market is going to continue in that style. Every high it creates is going to be higher than the previous high. Every low it creates is going to be higher than the previous low. Why? Because this market is on an uptrend. So these are the things you would see when the market is on an uptrend. Every high it creates is going to be higher. Every low it creates is going to be lower. But if this market is on the downtrend, now that's another type of market structure. We have the uptrend. On the uptrend, what we basically do is we basically buy the market. When the market is on an uptrend, you want to buy the market. So if this market now is on the downtrend, you will notice something like this. It has created a high, created a low. Then it's going to push back up, but going up now, it will not go above the high that it created. It's going to come around there and drop. Comes up again, it drops. Comes up again, it drops. So this is what you are going to notice when the market is on a downtrend. Why are you going to see this kind of pattern? The reason is because the market is selling. So everything the market creates will be pushing down. Every high it creates here, every high the market creates will be lower. Every new high it creates will be lower than the previous high. Look at this high now is lower than this. Now it created a new high here. This new high is lower than the previous high. The market is going to continue in that style. Why? Because the market is on a downtrend. So every high it creates on a downtrend will be lower than the previous high. And every low it also creates on a downtrend will be lower than the previous low. This is a low here. When market dropped here, this is a low before it pushed up. Now market came again, after pushed up, it came back down as low as this point and pushed up again. This is another low. Market came down, pushed up again. This is another low. Now where I ended my drawing is still another low. So this is what you will notice when the market is on a downtrend. This is what you notice. Sorry about the mistake. But this is what you notice when the market is on a downtrend. You will see series of, let me quickly adjust my screen. You will see series of higher highs and higher lows when the market is on an uptrend. While when it's on a downtrend, you see series of lower highs and lower low. It's simply the opposite of what uptrend is. That's what downtrend is. While on uptrend, we are having highs that are higher than the previous highs and the lows are higher than the previous lows. On a downtrend, we will have lows that are lower than the previous low and highs that are highs that are lower than the previous low, than the previous high. So that's how downtrend is. Now we've looked into the pattern of up, we've looked into the pattern of down. Now this brings us to ranging. So when the market is ranging, what do you see when the market is ranging? Now on a ranging market, now let me draw something like a support and resistance for those that know about it. Let me just draw this like this. Although this class is not a support and resistance class, so I wouldn't even explain what it is, what we call support and resistance. But those that know will know that that's what I'm trying to draw here. So now on a ranging market, now look at the pattern I want to use now on this ranging market. You will notice the difference now. On the ranging market now, the market is neither an uptrend or a downtrend. That's what the ranging market is. It's not on an uptrend, it's not on a downtrend. And in the forex market, you either buy or sell. So you want the market to be on an uptrend so that you know, okay, the market is going up, you buy. Or it should be on a downtrend so you know the market is coming down, you sell. But in a ranging market, the market is not on an uptrend, it's not on a downtrend. And what we basically do in forex is we either buy or sell. So what do we do now that the market is ranging? What do we do? Okay, let me leave what we do aside. Let me show you guys how the ranging market is. So the ranging market, you will notice that the market is buying and selling off from the same area, the same zone, area, anyhow you want to call it. Let's just call it zone. So the market started from here and it pushed all the way to this level. Then it pushed back down, pushed back up again to this level, push down, push up again, push down. This is how the ranging market is. This is the type of thing you will see on the ranging market. So this is how it is. The ranging market, a lot of people call it consolidation market, sideways market. Some would say the market is unstable. And I think that's a good definition for, or that's a good example or a way to look into the ranging market. Because what this market is doing is it's not giving you a clear signal if it's buying or it's selling. It's just showing you that both the buyers and the sellers, they are both active in the market, like they are trying to edge each other out, but no one is leading at the moment. That's what the ranging market is. So the market started from here, pushed here, created a high, came here, created a low. Fine. So we would expect that the next high it will create will be lower than this, so that it will be giving us lower and lower low. Instead, what did it do? It created a high. Okay, that's okay. Maybe it has changed to uptrend. Now we expect that okay, it will come down and not go lower than this, which it did. So what's next is to create a new high, right? Instead, what did it do? It came below. Let me drag it down more. It came below the low. That's simply what ranging market does. Let me adjust this. That's simply what the ranging market is, very unstable. I'm having problem with adjusting. Okay, let me try this. But that's what the ranging market is a very unstable market. A lot of traders they avoid this ranging market. A lot of traders avoid it. Why do they avoid it? It's simple. It's simple because there's no clarity for most traders in this market. They don't know whether it's to buy or it's to sell. It takes a lot of observation and experience and expertise for you to actually trade the ranging market. That's why a lot of traders, most traders, they opt out of this ranging market. And one thing about the market is the market ranges a lot. Even though the market is on an uptrend and a downtrend, inside that uptrend or downtrend, the market will still range inside and continue in that trend. This is what I mean. Like you might see something like this, that the market is pushing up, is pushing up. Then you will notice maybe something like this. It will play a bit, range a bit, then continue pushing up, continue pushing up. So that's how the ranging market is. It happens a lot inside the uptrend, inside the downtrend. You could probably find a ranging market inside it. Now this market now is now up to you. It's up to you now to know where and when to trade this market. Now this is just the basic of market structure. We'll be rounding up the class soon, but I want to say something key. I want to say something key now for the market structure. And before I say that, if you haven't subscribed to our channel, please subscribe and like this video so you get more content like this. So, one of the key things you want to do when trading is you want to know the structure, like I've said. Now you've known the structure, now you want to know when to enter based on the structure. You want to know when to enter based on the structure. So when the market is bullish, you don't buy when, for example now, let's say you want to buy a phone or any gadget. Probably now they are doing like a 50% cut off sale. That means they are giving discount. That's like the best time for you to buy that phone if you have the money. Because now you'll be buying it for way less than you should or could have bought. So it's the same logic that has been applied to forex. When we want to buy the market, we don't buy the market when the market is at the very top or the very high, even though it's on an uptrend. We wait for the market to retrace into a lower zone, a lower level before we buy. We wait for the market to retrace, then gets into a zone like this, then we buy. There's a reason for that. There's a reason for that. We will look into that. There's a reason for that. It's not that we just wait for it to come down. Why can't we buy from the top level? There's a reason for that. But I want to keep this strictly just for market. If you want to know more, you can check our page and watch the videos we have so you can understand why we buy at a certain level and not at a certain level. Despite the fact that the market is bullish, why are we buying at this level? Where are we waiting for the market to get to a particular level before we buy or sell? There's a reason for that. So we wait for the market to drop down. It has gotten to a discount level now. The price has come lower. Then we buy. We bid into this market and we push it up. It's the same thing for the sell when the market is selling. So when the market is selling, you don't just sell the market from any point. You wait for the market to get to a particular zone. Let me quickly arrange these icons. So we wait for the market to get into a particular zone before you sell. You don't sell when the market is at the bottom, because now this bottom part now is where the market is most likely going to retrace. When we say retrace, it's going to go the opposite direction. Since it's selling, the opposite direction will be the market going up. So you don't want to sell when the market is going up. So the market pushes up, that's not when you sell. You wait for it to get to a level where you know that okay, since the pattern this market is giving is that anytime it comes to a high, it doesn't go above the high and it drops. So what would you do? When it comes to a high again, it comes around that area, there are a lot of confluence that we look into before we buy or sell. So if it meets your confluence, let's say like candlestick pattern, and it gets to this level here, we call it resistance, but this is not a support and resistance class. But for those that know what support and resistance is, it gets to the support and resistance level. If you use candlestick pattern as your confirmation, let's say your only confirmation, then it forms like a bearish engulfing at this point. What would you do? You will take your sell because now you know, okay, this market is going to push down. So you would wait. There's a particular zone where you buy or sell on an up or a downtrend market. When the market is ranging too, when the market is ranging, although most traders avoid this range, but what some traders do, let me not say what traders that trade ranging do, but what some of the traders do is that when the market gets to the top level, they sell. When it gets to the bottom, they buy. This is good, but it has its effect. There's a bigger risk trading the ranging market. Why do I say it has its effect? The ranging market is unclear, it's uncertain. The market can get to this top and let me mark the top with a circle, gets to this top and he expects that okay, the market is going to come to this very bottom before it pushes back up. So what would you do? You set your take profit here. Okay, let me just draw it out. Put your this thing like this, then set your take profit here, your stop loss above the zone, something like this. Now you are expecting that the market will get here, then when e get here you buy and push it up, like you think you have seen easy money. But the market might decide now to do something like this, not get to that zone, just come down a little bit and push up, hit your stop, and might still even come back into the ranging because the market is unstable. So both the bearish, both the buyers, sellers, no one is actually in control of the market. So you might still now come down here again, but you've already lost your money. The confidence to even buy from here is gone because of how the market has played with you, how the market has maneuvered your, let me not say maneuver, but because of how the market structure has played out for you. So there are a lot of things you need to look into. This is just the basic of market structure. So I'm not going to go any further into it. We even shifted a bit from the topic, but it's all still relating, so that's fine. There's a lot and a lot that you need to understand for market structure. This is not just everything you need for market structure. Even these rules I gave you, these higher highs and higher lows, there are some times when markets will break these rules and still continue in the direction of the structure that it has given. But that will be for another class. So we'll be rounding this up. If you haven't subscribed, please subscribe and hit the like button so you get more videos like this. Thank you for joining us today. This is Datapoint Forex and Tech Academy. Goodbye.